Okay.
Well, can you see the
Yes.
presentation there? Okay.
Yes.
Well, good morning. Welcome everybody to a new seminar of JiLAEE. We are very happy today of having Raimundo Undurraga. Raimundo is an assistant professor of economics at the Industrial Engineering Department of the Universidad de Chile. He received a PhD in public administration from New York University and holds a BSc in economics and an MA in public policy from Universidad de Chile. Raimundo is an applied macroeconomist, and in his very interesting webpage, he claims that he tried to do development economics. I think that he does development economics. And well, he has recent work on gender discrimination in consumer lending, immigration, crime, and crime misperception, and on housing externalities in poor neighborhoods. Today, he will present information frictions in mortgage refinancing. As usual, you can interrupt the presenter, Raimundo, with a comment, suggestion, and question. And well, thank you so much again, Raimundo, for being here. And well, the floor is yours.
Thank you, Julio, and everyone for coming to this seminar. So this is a joint work with a couple of colleagues from Northwestern and Stanford, as well as a postdoc student here at the University of Chile, and another colleague from the Financial Market Commission in Chile. So this paper, as the title says, is about information frictions in mortgage refinancing. What's the motivation of this paper? What you see in this figure is the distribution of interest rates in Chile for mortgages between 2010 and 2019. Okay, so pretty much the story here is that the interest rates has been decreasing systematically at the point that almost the two curves are not overlapping after 10 years. However, at the same time, we have in Chile that the refinancing rates are very low as opposed to other developed countries, like for example in the US, that depending on the states, these rates of refinancing vary between 20 and 70%. So the question here is going to be why? I mean, why people don't refinance despite the fact that these interest rates are decreasing. This is not a new question. I mean, this has been, the refinancing inertia has been extensively studied by other colleagues. There is a recent paper by Anderson and co-author in the AR that do a good lead review about it. So there are many economists that have been thinking about this question before. However, there is still little evidence on the sources of this inertia. There are some hypotheses related with market power, basically search costs. I mean, people don't refinance because they face a very high search cost. They could see also some switching costs. I mean, how to change from one bank to another one has some administrative and legal costs that could be too high. There could be some strategies on the side of the banks to generate product differentiation at the end of the day, end up confusing the clients about what are the differences of taking one mortgage here versus in another bank. Or this could be alternatively a story, a more behavioral story. You know, I mean, maybe people don't refinance because they have biased beliefs about the potential savings that they could obtain upon refinancing. Or maybe there is an awareness story here. Maybe people don't really know that they can refinance. And I will give you some evidence about that in the context of Chile. So any of these potential hypotheses behind the lack of refinancing could be related with information frictions. And what we will do in this paper is basically trying to tackle any of those mechanisms through an information experiment with borrowers in a big bank. So what are the implications of this question for the literature? On the one side, there is a large discussion about the level of market power exerted by banks over clients in terms of the type of search costs and switching costs that they impose over clients. So we want to inform a little bit about that. Also, there is a macro discussion on the effects of monetary policy. Refinancing tunnel is an important tunnel for monetary policy to affect the economy. And we want to learn whether information can change the demand of refinancing. So in that case, whether monetary policy interacted with information. Sorry?
Yeah, Raimundo, yeah, sorry to interrupt. So one question is, so do you have a sense or like a back of the envelope calculation on more or less on average, at least during the period that you consider, how much money they are leaving under the table because of not refinancing? So is,
yeah, this is about
a sense of that?
Yeah, I have a sense of that number. And I can give you some details in the next slides, but I can give you a response so far. We will find that the potential savings are around $4,000, taking into consideration the total amount of your mortgage, right? So that's going to be about, for an average borrower, it's going to be about 4 months of salary, okay? Which is not a small amount in our period of analysis, right?
Okay. Thank you.
But that's on average. I mean, there is some dispersion for that number. Okay. I mean, yeah, just taking your point, we're not talking about a small problem. I mean, there are potential gains over the table that people are not taking, and those gains are important, are relevant. Okay. So a third implication of our paper is, I mean, if in equilibrium you start to inform people about the refinancing gains, and people start to refinance because of that, what's going to happen? I mean, it could be that banks start to increase the prices at the origin, right? I mean, any new borrower that want to take a mortgage is going to face a larger interest rate. So these dynamic effects in equilibrium is important for policy, and we want to we're going to model. I mean, we're going to design a structural model, and we're going to estimate it with our experimental data in order to give some evidence on that. And finally, if we want to regulate this market, we need to understand what are the sources, and one of the key contributions of our paper we expect to be to inform which are those particular sources of inertia, which are those particular information barriers that people are facing, so that we can use those evidences in order to design the new policy in this market. Okay, and we're working with the Consumer Protection Agency in Chile precisely to take this evidence to a higher level and redesign the mortgage information policy in Chile. Okay, so what are going to be the specific research questions that we will face in this paper? First of all, we want to illuminate what are the information frictions affecting this market, and who are the clients that are facing these frictions in a higher intensity. Second, we want to test whether these information interventions affect in some way the search behavior of the borrowers. And finally, if this intervention is successful, whether the demand changes are going to affect or going to generate any indirect effects on supply on the side of banks, and whether that new intersection of supply and demand is going to generate the new pricing in this market. So those are going to be the three key questions of our paper. Probably today, we're going to discuss the first two in detail, and if we have enough time, we can go through the last one. Okay, this is just a simple framework to think on this question. So consider a borrower I who has a mortgage at Bank J. So this guy has this utility here, right? And he's trying to understand if it's worth or not to change from one bank to another to refinance their credits, right? So they will have an expectation of the benefits. That's going to be the difference between the new utility in the new bank minus the switching cost, right? And he's also going to consider what are the search costs involved in the process of refinance. Okay, so the first barrier that these guys could face is awareness. I mean, maybe this decision is never going to be in his face because he basically don't know that he can refinance. So awareness here could be one hypothesis, especially for people who are low educated and do not know how to navigate the mortgage market. Okay. A second one could be a story of beliefs. Maybe people know how to refinance, but they believe that the potential gains that they could obtain are very little and do not compensate the associated cost. Okay. So the third one could be search cost, maybe getting the information about the conditions offered by other banks in the market is not easy to obtain, or maybe people have to, spend a lot of time trying to understand how this market works. So there could be some search costs that stop people from trying to refinance. And finally, there could be some switching costs. Basically, they value their home bank a lot. They lack where they have their mortgage right now. Or maybe there could be some administrative and legal costs that are much larger than the potential benefits. So we want to understand whether that could be one of the potential channels behind this story. So we have these four classical potential barriers that are stopping people from refinance. And what we will do here in our paper is trying to experimentally vary the type of information that people receive, trying to tackle one of these specific potential barriers separate. So for that, sorry, there is a question in the chat. I'm happy to receive your questions. I mean, of course, this is an early version of the paper, and we're happy to receive your comments. Alan Silverman says, which is the percentage of borrowers that could benefit from refinancing? Maybe this is a small societal problem in the sense that a large majority of borrowers pick the best mortgage offer in their first attempt and do not need to refinance. So this is a very good question. Thanks, Alan. 89% of our population of interest are going to have potential gains that are positive. Okay, so answering your question, this is not a small share of the population. And I will show you then how do we calculate the potential gains from refinancing. I hope I answered your question. Yes.
Yeah, sorry to interrupt. So one question is it on the supply side? So is it common for banks to basically propose people to propose refinancing even from other banks? Because, for example, here in Argentina, there is not public information, but there is information about about the consumers, the borrowing by consumers, and so you may buy a data set where I don't know whether people has a mortgage or not, under what conditions, and so on. So is it do banks has an active policy on that?
Okay, there are two things here. Thanks for the question, Julio. One is that people could offer refinancing for their own clients. Okay, so that could keep them within the bank and avoid that they go to another one. Okay, so that's one point. They're not very, very active, okay, because people don't really know that they can refinance, and I will show you some evidence about it. So they don't have the incentive to inform them, right? And second, people receive a lot of information from banks, but that information it is not necessarily well designed, to convince people to change from one bank to another one. Okay, and we have some evidence about that I will show you later on. And finally, financial education in Chile is very low, and so if this operates at some level, it is only operating for those who are highly educated, which is a very tiny population of mortgage borrowers. So I wouldn't think that this is a big issue. It is not that banks are competing across the whole market. Probably they are competing for a subset of potential borrowers.
Thank you.
So what we will do is to partner with this big bank in Chile. We will implement a large-scale intervention with around 250,000 borrowers in this bank. We will basically change a little bit the quarterly letter that they receive on the conditions about their mortgages. And each of the pieces of information that we will add to that letter is going to tackle these 4 different potential channels that are stopping people from refinance. Okay, this intervention is going to be through email. There's a high advantage of that, which is that this is extremely low cost, and we will be able to track whether people are actually opening the letters or not. Alan Silverman has another question. He said, this is a question for later. I do not want to interrupt. Refinancing offers include only lower interest rates, diminishing borrower debt, or lower interest rate plus more installments, modifying the debt profile, but not its amount. Okay, this is part of the slide where I present some evidence on the institutional setting. I think I will be able to answer you, Alan, in more detail later on. Okay. Okay, what are we're gonna estimate in this paper? First of all, some direct effects on borrower beliefs and what are their searching behavior. In particular, our outcomes will be whether they submit or not a refinancing application, either to their own bank or to other banks. Okay, and finally, whether they end up refinancing their credits or not. I mean, they accept the new condition that the banks offer, or basically they are rejected in terms of their the refinancing attempt. Okay, and then we will show you some heterogeneity analysis by several different kind of covariates, including potential gains from refinancing, the level of incomes of the borrowers, age, baseline beliefs about the potential gains, and so on. So the implications, as I said before, is, I mean, we want to exploit this experiment to generate a model of demand and supply of mortgages with information frictions, and try to understand whether when central banks reduce interest rates, basically refinancing could be an important channel or not for increased consumption. Okay, so that's the final objective of this paper, trying to understand whether changes in the demand generate some reaction in the supply, and at the end of the day, we get a new equilibrium pricing. Okay, and finally, there could be some dynamic effects here. If everyone starts to refinance more, maybe this is going to translate into higher interest rates for the new borrowers that are entering into the market, because their interest rates are going to be higher. So we want to test that hypothesis, because in equilibrium, the welfare effects could be diverse here. I mean, it is not obvious that everyone refinance is going to be a better outcome in terms of welfare for everyone. Okay, so we want to understand how that dynamic effects end up changing the prices at the origin of the mortgage markets. Okay, some preliminary results, pretty rational. We find that treated borrowers actually update their beliefs when they receive this information. They now believe that the benefits from refinancing are much higher than before, which is an expected result. It's our first stage of our information experiment. Then we find that these informational interventions start to increase the share of borrowers that actually submit an application for refinancing. The effects are going to be very small in terms of levels. However, it's going to be very large effects in terms of percentage change. Indeed, we double the baseline search rate. This increased search is going to be quite sensitive on the potential gains that people perceive are going to obtain from this process of refinancing. And we will find that basically the main barrier for people for stop refinancing is biased beliefs. I mean, that's pretty much the story here in this paper. It is not that people have problem with search costs or with switching, or they are not aware about the opportunity to refinance, but basically they have very biased beliefs about what are the potential gains that they could obtain from this process. I mean, that's going to be the largest story of this paper. Unfortunately, we will not find large effects on refinancing. That's because, unfortunately, immediately after the implementation of this experiment, I mean, a month after, there was a big spike in the interest rate at the market level. So the incentives of people for refinancing naturally decrease, and the banks started to reject a lot of the search behavior of, the application for refinancing. So that ended up generating a much lower effect on actual refinancing from our population of interest. And I will show you some evidence in that direction. So what's the related literature? A lot of paper trying to understand whether information can change the search behavior of people. This is in finance, experiments on switching savings accounts that says that information actually doesn't work. The same with credit card borrowing. How people allocate their money across different credit cards with different interest rates. People seem to be rational, and when you provide them information, it seems to not work. There is also some literature about whether information can allow especially poor people to take up more public programs, and some evidence for the US that seem to be successful. You provide more information about the benefits of public programs, and people actually take up more of those programs and improve their lives. There is another line of research very active lately on the impact of financial regulation in the presence of information frictions. Some paper, for example, from Keys and Awarwell find that CARD Act actually failed to increase refinancing among borrowers. There are some other empirical models that impose some structure, choice models that try to understand what's the effects of this kind of policies of regulation policies on refinancing, and they still find some null effects about it. And people, even though this CARD Act increased competition across banks, people do not refinance more. Now, the case of the US is a little bit different because the refinancing rates are very high compared to the rest of the world. So the margin of increased refinancing is very little. Right? And finally, we have this macro literature of the implication of the pass-through of monetary policy. We want central banks to reduce the rates so they can increase consumption and investment from the economy. And of course, the refinancing channel could be very important to activate that effect. And search and market power could be playing a role there. I hope people are very interested to understand whether search friction or switching frictions actually are impeding that the monetary policy generate the expected effects. And there is another literature that is very recent as well, from Anderson and Berger, 2 papers published in the last 2 years in the AR. They have a discussion about whether people are not refinancing because there is extent-dependent variables affecting this. The story is about the level of the interest rate versus an hypothesis that's more behavioral. Maybe people are very persistent in their behavior. They have some beliefs that are very difficult to change. So this is not about changes in the interest rate, but more about changes in the behavior of people, in their beliefs. So that's a time-dependent hypothesis, and there is a large discussion about these 2 hypotheses, and we want to try to eliminate that discussion as well through our experiment. Okay, so our contribution is going to be mostly disentangle the specific frictions that could be working behind this market. That's something that has not been studied with detail and has not been studied experimentally. So that's gonna be one of the important contribution, and the other one is gonna be the model that we will offer to understand whether demand change actually generates some supply side responses that at the end of the day end up generating some new equilibrium in the mortgage market. So we want to understand that dynamically over time, and we will have data to do that. Okay, so this is the setting. In Chile, we have that the refinance, the mortgage contracts takes between 20 and 30 years, mostly fixed rates contracts. 99% of the contracts in Chile are based on fixed rates. If you want to refinance and you want to change from one bank to the other one, the original bank is going to charge you at most 1 month of interest over the prepayment. So there is a cost, there is a switching cost that is that is not small. Now, something that is important to mention that is that this is not a market like in the US where people refinance their credit because they have some animus of equity extraction. I mean, in Chile, that market is very, very little. It has not been exploited yet. So if people are going to refinance their credit, it's just to get a reduction in the rates so they can get some potential savings. I mean, they're not doing businesses here like in the US with the equity extraction market. And finally, immediately, I mean, a couple of months before our experiment, Chile implemented a new law of portability. So that law of portability basically what did is reduce the switching cost. So people now had to pay a maximum amount of legal and administrative cost that, of course, incentivized people to increase their refinancing behavior, right? I mean, that's what the expected effect of this law, and that was implemented immediately before our experiment took place. Okay, so something important in our information experiment was to explain people how this new law works, why it's important, what are the new maximum costs that banks can charge you if you want to change, and so on and so forth. So our bank, it has the 20% of the market, so it's a big bank. As I said before, around 230,000 borrowers are going to participate in our experiment. The average borrowers has a mortgage of $70,000. 75% of that is going to be basically the outstanding debt. I'm sorry, the mortgage debt, and the resting 25% is going to be the consumer debt. Okay, as you see here, the share of people that actually search in this market is very small. And actually, in 1 month, the people that are able to refinance is also very, very small. I mean, we're in a market in a setting where people basically either don't know that they can refinance, or actually they are facing a lot of frictions. I mean, it is weird that if you have potential gains that are very large, people are not doing anything. So this is quite puzzling and motivate why we want to do this experiment. Okay. So let me give you now.
Wait, sorry, maybe I missed it. How do you measure search here?
Search here is whether you submitted or not an application for refinancing in your bank.
I see. Okay. And can I ask one quick question, since we talked a little bit about the market?
Yeah.
Are they also, I mean, do you know what percentage of people that have mortgages have it at the same bank that they have other banking services?
You mean how many people, I mean, what's the share of the market of people who refinance in their own bank?
That get a mortgage from their own, like, for instance, I would get my mortgage through the bank that I normally use, for example, whatever that bank is. Mm-hmm. And they give me somewhat not preferential treatment, but there's like some degree of reciprocity there. And then there's also a little bit of bundling going on because maybe I can get a slightly lower rate or something. Maybe I have loyalty to the bank. So are you going to be able to show, or do you have any idea of like how many of the people who have a mortgage also have other financial services with the same bank?
Yeah, indeed. When you port your portfolio to another bank, you have the choice to port other kind of products. Okay, so typically your decision is not going to be only about your mortgage, but probably it's going to be related with other kind of products. I will not show you evidence on what's the level of importance that what's the role of the other products in this decision. I don't have data for that, but theoretically it should be an important insight. Yeah. I don't know if I responded you.
Yeah, that's fine.
Okay, so as I said before, borrowers here in this market search very little. Unfortunately, few of those searches actually translate into new contracts. So what we have here is in the black line, we have high income borrowers. In the blue one, we have low income borrowers. These are the potential savings that they could obtain from refinancing. And I will explain you in detail how I calculate later on these potential savings. So the larger are the potential savings, people tend to search more, which is expected. And of course, more educated people, that is high income people, tend to search more than low income people. But again, if you take the y-axis here, like the order of magnitude of the search versus refinancing are very different. Okay, so there should be a problem here, another friction. I mean, when people search, after that there is another friction that is operating that has to be about switching costs, and it's something that we will try to illuminate with our experiment. Okay, when we ask people, well, have you ever refinanced or not, and what are the kind of reasons for not doing it? We see, first of all, this is only among those people who actually responded to the survey. So it is a self-selected sample, maybe not representative of the entire market. This is about 10,000 people that answered the survey. 60% of them have never attempted to refinance. Some have done it, but were rejected. Some other didn't get better offered. And a little bit below the 20% actually got refinancing from the banks, okay, or from other banks in the markets, okay. But when you ask people why you didn't refinance, most of people basically attribute this to either knowledge of the process, they don't know how to do it, okay, or maybe because they are very satisfied with the current bank. There is a switching cost, there is a disutility from changing, from abandoning your bank, because maybe they don't have lack of time. I mean, they lack enough time to do a good search process. They have doubts about approval. They don't really know. I mean, maybe they expect that after doing all this process of refinancing or applying for refinancing, maybe the gains that they will obtain from that process are very little, and that stops them from actually attempting to refinance. Some people say that they don't know how I mean, they didn't know that they could even refinance their credits. But in general, if you take any of these potential reasons, all of them could be potentially changed through information, and that's the important message from this figure here. I mean, we want to change this reason through information. So what data we will have for this experiment? We will do an agreement with the Consumer Protection Agency in Chile. They have a regulation that obligates all the banks to give all the information about their mortgage borrowers every month, and how they are evolving in terms of payment. So we basically have the stock of all outstanding mortgages in the market from all the borrowers in Chile. We have the flow of all originations as well. And we have the loan terms and performance of borrowers in paying these mortgages over time, okay? Finally, we also have some information about the borrowers. Second, we have information. The new portability law obligates the banks to report the CMF, which is this Consumer Protection Agency. The banks have to inform the CMF about any attempt of refinancing from borrowers. So here, if people want to refinance, they submit the application to their own bank and they say, hey, I want to change from bank B to bank A. So they have to inform that to the CMF, and so we can observe in practice all the attempts of people for refinancing. Okay, the information requests actually get recorded in the databases of the CMF, and we can observe that. So we can basically observe search behavior for everyone. And finally, we will complement this data with survey data. It's going to be a self-selected sample because not everyone wanted to respond to our surveys, but there we will be able to check some first stage regressions related to whether information actually changed the beliefs of people in terms of the potential gains that they believe could obtain from refinancing, and so on. Okay, and we will conduct this service before the experiment, during the experiment, and afterwards. So this is the experimental design. I will explain you in detail how are these 5 pieces of information, but just to give you a summary before, there is a treatment about awareness. We basically, every borrower receives quarterly this letter informing the actual standing of your mortgage. We will add to that a very small piece of information saying, hey, did you know that you could refinance your credit? And that's all, right? That's the awareness treatment. It's very basic. Second, we will implement a new piece of information to that letter that basically say people what are the potential gains that they could obtain if they refinance, and we will give them what's their position in the markets and what happened if they refinance their credits at the market level, at the market interest rate. And that market interest rate is going to be for a set of comparable borrowers in terms of the borrower's characteristics as well as the mortgage characteristics. Okay. Then we have a search treatment. This is going to be basically a piece of information explaining people how to search in the market and how to submit an application. And finally, we have a switching information treatment where we explain people how to switch from one bank to another one. I mean, step by step, we explain them how the new portability law works and how to implement it in practice. Okay. And finally, we have a final intervention that basically couple all the individual pieces in one major piece that we call full. Okay. And finally, we have the control group where, of course, we don't distribute any of these pieces, but just receive the normal letter from their banks. These letters are going to be sent by the Consumer Protection Bureau, not from the bank, so we can because I mean, this experiment is joint with them, so they wanted to test how would this be in regime. I mean, in the future, if this experiment work, they want to implement a new law where the new letter that banks have to send to their clients have to include this kind of new pieces of information. So those letters are going to be signed off by CERNAC, which is this Consumer Protection Bureau. So we wanted to replicate as much as possible the scalable situation in the future, right? And finally, we can verify the reception and the opening of the email, so we can test whether there is take up or not in terms of the treatment. Okay, so this is just a summary. Sorry.
I guess we're going to see the results later disaggregated by like maybe income or different degrees of heterogeneity. But like what you showed before is that it looks like a third of the people who try to refinance actually are able to, whereas another third, I can't remember what the 3 choices were. One was refinanced, one was rejected, and then the other one was.
Yeah, but it is a very self-selected sample. This is not representative of the market, right? I mean, that's why you find numbers that are much larger compared to the overall market, right?
Okay. Do you know? I was just wondering how that compares to things like, well, like household income or other measures that you're going to be looking at, because in expectation, it's not just the value of the refinancing, it's that conditional on your likelihood of getting it. And I was just wondering if you know before.
I will show you some results on that direction. I will show you. Yeah. Okay, this is the experiment timeline. This experiment was done during the last year. So until March of the last year, we implemented a baseline survey. We actually sent this invitation to all the 250,000 borrowers that participate in the experiment, whether they wanted or not to participate in this survey. A little portion of them actually answered the survey, around 5% of the sample. And then 3 months later, using all the administrative data we had in hand, we calculated what are the predicted gains that they could obtain if they refinance. And I will explain you in detail later on how we calculate that. Then 2 months later, we send the letters, okay, to all these people, depending on whether they were assigned to either of the 5 types of treatments. And then we implement some follow-up surveys. Okay, these follow-up surveys were implemented immediately after the implementation of the experiment, and then some other surveys were implemented a couple of months later. So we can pretty much build the story of how these beliefs change before, during, and after the experiment. Okay. So how to measure gains from refinancing? This is an important point, because you don't want to make mistake here, especially because you are playing with the expectation of people. And indeed, the Consumer Protection Bureau was very worried about making mistakes here, because they could imply some legal problems in the future. So what we did is basically the following. We had more than 1 million mortgage origination during the last decade, of which around 150,000 were refinance loans. We basically estimate the regression of the interest rates against a bunch of covariates that are, related with the loan size, the income of the individual, what's the remaining terms, and other kind of covariates. We also include some month fixed effects, and then we predicted for every client what would be the interest rate that they would obtain, considering some assumptions that are very conservative. For example, first of all, what's the most recent month fixed effects? We plug in that month in particular, so we get the most actual market condition, and also we assume that the loan will be refinancing to a 30-year term, so that's going to imply a larger rate on average. So that's going to imply a lower potential gains from refinancing. And that's going to be important because, again, we don't want to overstate the gains. So we don't want to make a failure in the expectations of people. So the people could react negatively if we are lying them. Okay, so we need to be very conservative in our estimations. Okay, so finally, we will calculate the expected gains as the actual rates that they are paying for their mortgages, minus the predicted rate, which is the rate that we calculate from this exercise, minus the refinancing cost. Because, if you want to switch from one bank to another, you have to pay some administrative legal costs, and you want to account for that in this calculation. So we also rest that from this equation. So then we get the expected gains. How are these expected gains in practice? I think I got a question at the beginning from Alan that basically wanted to know what share of people could gain something from refinancing. Well, this is the answer to that question, Alan. Around 90% of people have positive gains from refinancing, given our conservative calculations. This is the distribution of those gains in a cumulative graph. How much it implies those gains? This is about 13 monthly payments. So if you have a loan for 20 years, this is going to save you more than 1 year of payment. That's not small, and it is equivalent to around 3 times your monthly income. Okay, so that's in total. To give you a sort of order of magnitude of what the size of the money that you are putting over the table. Okay, so these are the treatments in a very practical way. This is the awareness treatment. So, I mean, this part here is the normal part of a letter that you receive every quarter, and we are just adding this piece below that you see here, that basically tells you that you can refinance. Okay, and then for the belief treatment, which is the second arm, we give you this thermometer here where we explain you, hey, this is the market level rate for those people who are very similar than you. Okay, and this is the interest rate that you are paying. So this difference in the interest rate could, if you were able to refinance your credit at the market level, then you could obtain this amount in terms of annual gains, and you could obtain this amount in terms of total savings. Okay, and we inform you personally, given your own characteristics, what are your potential gains from refinancing. So this is the belief treatment. This is the search treatment. First, we explain you how is this mortgage decomposed. I mean, you have a debt level, then you have the interest that you have to pay over that debt, and this is the total amount that you have. And then we explain you how step by step can you submit an application for refinancing. Okay, and we're trying to be very specific and very, we pre-tested this with many clients before the experiment, just to be sure that people understand the information. So the aim of this treatment was convince people that searching it was not costly in terms of time, and basically could give them a lot of gains if they can do it well. And finally, there is the switching treatment, which is similar than the last one, but here we explain you what the kind of switching costs that you have to pay, administrative and legal costs, and how is the process that you have to navigate once you already did the search. Okay, so that's pretty much the experiment. This is the full treatment that basically put all these pieces of information together. Okay, so this is the balance table. In general, we are quite balanced. On average, the interest rate is 4.4. This is the monthly payment in terms of dollars. These are the predicted gains. Okay, and these are some borrower attributes like income, age, and female. The important thing about this table is that in general, we do not reject the joint test of equality of distributions across the different treatment arms. So this is a well-balanced and a well-designed experiment. This is the regression that we're gonna run. Pretty simple regression. Something that is important is that our randomization was stratified by a number of covariates. So we create bins of stratas in those covariates. So we have to control for them in our regression if we want to recover the causal effects. That's by design something necessary in our causal identification strategy. And here are some basic statistics that are necessary to understand the story. So this is the take-up rate. More than 50% of people actually opened the emails that they received with the information. Unfortunately, we do not know whether they actually opened the PDF with the information, but at least we know that they opened the email, and that rate is pretty balanced across the different treatment arms. So we don't have problems of differences in compliance rates across the treatment arms. So that's good for the interpretation of the effects. Okay. Also, the take-up rate is somewhat high compared to other kind of information experiments, and we are happy for that. And then we have the results. So first thing to show here is, in any information experiment, you want to change beliefs, right? I mean, if the information experiment is not changing beliefs, then it is difficult to argue what could be the mechanisms that are, driving the effects on the main outcome. So this is a sort of first stage exercise that you want to implement in any information experiment. So we basically ask people, how likely is it that you refinance your credit in the future? I mean, you mean that's going to be highly likely, somewhat likely, not likely at all, or very unlikely? So this is just a belief question. I mean, it is we're just seeking subjective responses. What we have here is the control mean. Almost, I mean, a little bit more than 40% of people say yes. I will refinance. I will probably refinance likely or highly likely. And these are the treatment effects that you see here. So first of all, the belief treatment seems to be driving the change in beliefs more than the other kind of treatments. However, all of them actually are changing beliefs in some way, and the effect size are not small. This is about 25% change, and this is about 30% change relative to the baseline level. So these are not small effects in terms of beliefs. Now, if you now move to the effects on search, so whether you actually submitted or not an application for refinancing, so that's a more hard outcome if you want. You still have some important effects in terms of levels. Those effects are quite small, but if you compare those effects relative to the control mean, those effects are quite large, especially for the belief treatment and the full treatment. Indeed, the full treatment more than double the baseline rate. Okay, so in equilibrium, if people start to get more and more informed about this benefits of refinancing, potentially these rates of searching could increase much more, and that could lead us to a new equilibrium in terms of pricing of this market. That's the expectation of this this experiment in the long run. Of course, we're just treating a portion of the market, just one bank, and not all of them read the letter. So in expectation, if you start to repeat this treatment over time, you should expect that these numbers increase much more. Okay, so if you split these effects by whether people actually open the email or not, you have to find what we find in this graph, which is all the effects come from those people who actually opened the email. So the experiment is working. So that's the main message of this table. And second, something that is going to be important is that, you know, people tend to forget about this kind of interventions. I mean, they receive a letter with information, they get the information, and some weeks later on, they forget the information, and then they start to thinking on other things. And indeed, that's what we are finding here. I mean, all the effects comes in the first 2 weeks. Okay, in the first 2 weeks there is a lot of action, and then from weeks 2 to 4, 4 to 6, and after 6 weeks, all the effects are much closer to zero, right? So most of the action in this experiment is coming from the beginning of the receiving of the information. So this is telling us that maybe we need some reminders, repeated reminders, in order for this kind of experiments to work. Okay, so this is how these effects change when we separate the sample by quartiles of potential gains from refinancing. So people who have more potential gains naturally tend to search more. Okay, so this means that people who have either higher income or have longer terms in terms of the number of terms that are remaining to be paid are typically people who have more potential gains from refinancing, and those are precisely the ones that reacting more to our treatment. That's telling us that probably this is more a story of a state dependence more than a time dependence story. Remember at the beginning there was this discussion between Bergen and Anderson in the AR papers in the last 2 years. They were discussing whether this is a story of the rate, I mean the level of the interest rates, or this was more a story about the persistence of the behavior of individuals, more a behavioral story, if you want. Okay, so this is telling us that this is more about a state dependence. I mean, if you change the interest rate, if you change the potential gains that people could obtain, then of course people will react more to this kind of information. These are somewhat similar graphs. All are telling you the same. If you have larger incomes, then you're going to refinance more, and that's because the potential gains that you could obtain are also larger. This is typically because higher income people have larger mortgages, right? I mean, the amount of their mortgages are larger, and so the potential gains that they could obtain from refinancing are also naturally larger. Okay, the same happened with age. These people people who are younger are typically people who have a longer term. The remaining term of their mortgages is larger, so the potential gains that they could obtain is also larger. So the potential gains, I mean, the information is going to interact much more for those who are younger in this market. So that's pretty much the story. And I think these three graphs, the potential gains graph, the income graphs, and the age graphs, all talk together and all points that in the direction that potential gains could be driving in a meaningful way the effects of this experiment. We also tested some other characteristics like gender and education, and we didn't find any heterogeneous effects. So I think in my last minutes I will go directly to some striking results that maybe you guys can help me to disentangle. So this is the distribution of the bias in the perceived gain from refinancing. So when you ask people, hey, tell me how much do you think you could gain if you refinance your credits? And then we rest that to the actual gains. You obtain some level of bias, right? So the first thing that we observe in this image is that there are many people, most of them, 75% of them around that, are optimistic people. So they believe that their perceived gains are larger than the actual gains that they could obtain from refinancing, okay? So you have a quarter of people who have below zero gains. So they are pessimistic about the options of refinancing, compared to quartiles 2, 3, and 4, who are typically optimistic people. So what we do is basically we divide the population in these 3 quarters. Quarter 1, remember, are pessimist people, and the other ones are optimist. People who are more optimist are people who are more likely to declare that they attempt to refinance likely or highly likely. Okay. However, when we estimate the effects of receiving the full treatment, we find that the effects are larger for those who were pessimistic. Okay. And this is also the story when you measure the effects in terms of search behavior. I mean, those people who are searching more are precisely those who were more pessimistic at the beginning. So what we understand from this result is that our information treatment is changing the beliefs of pessimistic people. So that's, and maybe that was expected, maybe not, I don't know, but we are telling people who were pessimistic, hey, you believed before that your potential gain would be lower. Hey, look at this. Now you can see that your guess was wrong. You actually could obtain much larger gain than you thought, right? And we are telling the opposite story for the optimistic people. The optimistic people thought that their gains could be much larger than before, than the actual gains that they could obtain. So now they are in some way get frustrated about the news that we are giving them. So that's pretty much the take of this graph. Right? We're trying to interpret a potential alternative explanation. We're not finding them. So if you have any idea of why we're finding this, I would be very happy to hear you. So our story so far is that pessimistic people seems to be driving our results. Now, this is just a distribution of the amount of time that people who search actually end up obtaining refinancing. Okay, and it's telling you that in a horizon that goes from 0 to 11 months, only 8% of people who attempted to refinance in the control group actually obtain refinancing. So already that figure is very small, but also the amount of time that it took the process is also very large. So this is telling us that between search and actual refinancing, there are also frictions that we need to study more in order to understand why people are not refinancing. Okay.
When they refinance, they lock in the rate that they like, because you were saying that there was a big rate change after this.
Yeah, I will show you that. Yeah. Sorry.
No, I was wondering if they're locking, like when you're doing the refinance application in the search, if you're at that point locking in some interest rate, or is there some sort of risk about the interest rate at, like, you have to wait till closing to find out what the actual interest rate is?
Well, the answer to that question, I don't know. I have some hypotheses. My hypothesis is that, well, I will show you. I think I will answer in the next graph with that. Because if you look at this graph here, this is when the experiment was implemented. Immediately after, I mean, in the middle of that experiment, there was a big spike in the interest rate at the market level. And that could be explaining why a lot of banks started to reject the refinancing applications, okay? And that could explain also why it took so much time for those who actually got refinance. Sorry, for those who actually search, got a refinancing. Okay, it took a lot of time, and probably that could be guided by what you say. I mean, there was a big spike in the interest rate at the same time once people were searching for getting refinancing. So that's our hypothesis. That was very unfortunate for our experiment. But at the same time, it could be interesting for macro people. Maybe macro people are more interesting to understand what are the effects of this kind of information experiment, precisely when you need to find alternative ways to activate the markets. I mean, which is the case when this experiment was implemented. So these are the effects on refinancing rates. We are talking about very small numbers. We're also talking about a story of people who refinance, or people who have a lot of potential gains, who are in the right side of this distribution, as these graphs show as well. You know, these are the quartiles of the potential gains that people could obtain from refinancing, and all the effects come from those who are in the quartile 4, which are precisely the ones who gain more from this. But still, the figures are very small. I mean, and we would expect that this could be larger if the interest rates were not increasing at the exact moment of the implementation of our experiment. Now, if you take the compounding effects over time, we could get to the level of 6% in a 5-year horizon, which is not small. It's not that large either. But if you continue repeating this information experiment over time, we could get something on that order of magnitude in the long run. Okay, at a very uncostly, at a zero cost, by the way. I mean, that's something important to mention for the cost effectiveness debate. Okay, so what have we learned from this so far? Information frictions are actually playing a role in the lack of refinancing. Our interventions are increasing the search for mortgages, and it seems that the level of potential gains is playing a big role in that story. The increase in refinancing, it was significant for a small portion of the population, especially those who got large gains. However, the order of magnitude of the effects were much smaller than expected, and probably that was explained by this increase in the interest rate at the same time of the implementation of the experiment. And it seems that high income and younger borrowers are more responsive to interventions, and that could be important for the design in the future of this kind of. I mean, if you want to scale up this intervention, maybe we should put more effort on these particular groups. Okay, some evidence that effects could be operating through the channel of beliefs is that pessimistic borrowers seems to be more responsive, and also treatments that inform the gains from refinancing, in particular the belief treatment, seems to be the ones that drive the strongest impacts in our population. Okay. I don't think I will have enough time to talk about the equilibrium effects, basically because this seminar is just 1 hour long and I am out of time right now. But just to tell you a little bit what we want to do, we want to design a model of demand and supply with a particular innovation, which is information frictions. So those information friction could go in the way of search costs, switching costs, awareness, and biased beliefs. So we will play with our experimental variation in the access to information. We will use that exogenous variation to pin down or to vary these information frictions that people are facing. So expecting to change the demand side of this market, and then see whether the banks react to those demand changes by varying their pricing. Okay, so in equilibrium, we want to know whether increasing the level of refinancing from individual through information actually generate any change in terms of the prices in equilibrium, especially on those new originations in the market. I mean, probably the most interesting question here is to understand in terms of the dynamic of the market, whether increasing levels of refinancing is going to change or not the prices of the new originations of mortgages in the market, because that could give us some sense of the welfare effects of increasing refinancing. It is not obvious at all that large rates of refinancing are gonna put the market in a better position, compared to a situation where there is some level of refinancing that do not have some important impact on the interest rate of the originated mortgages in the market. So that's all for today. Thank you very much for your comments and for your attendance. If you have any additional question, I'm happy to hear you.
Raimundo, well, thank you so much for a great presentation. So I have one question. It could be that perhaps there is some role for trust here. So basically the trust in the bank, in the sense that, for example, if you consider for example, the people who overestimate the gain, perhaps this is people who distrust the bank because they think that they have a bad deal or not. And the people who underestimate is people who trust somehow, or I don't. My impression is that I think that because I hear from a bank here also that, for example, there is very low take-up rate in apparently very good offer that they send to their clients. So do you have a sense somehow to compare with another product that or another benefit that the bank offered? So how common is that people really take what the bank send? Because again, perhaps they don't trust, or
exactly.
Some people trust, some other people they don't trust. So I don't know whether somehow if there is a role for trust in your analysis.
Yeah. No, that's a very interesting hypothesis, Julio. I mean, my prior is yes. I mean, probably there is some trust issue here. I receive calls from my bank every day. I don't want that I mean, my time has some value. I mean, I start to distrust the bank when they start to push me to take more and more products. And maybe there is a story on that side. Okay. Also, we are in an age where people are saturated of information. You know, so anytime that your bank is calling, I mean, that bank is competing with many other sources of information that is in your cell phone. So you don't want to hear more about your bank. So you want that your bank works well with your actual products, and that's it. You don't want to receive calls from your bank. So there could be a trust issue, but there could also be an issue of information acquisition and the cost of information acquisition. Unfortunately, we cannot test that. We had that hypothesis of trust at the beginning. We wanted to exogenously vary whether the CERNAC logo was posted or not in the letter, but they didn't allow us to do that. That could have helped to test the question that you have in mind, because it's different if this letter is coming from the logo of the bank versus the logo of the Consumer Protection Agency. They have the hypothesis that much of this story could be driven by trust, and that's precisely why they want to put that logo of CERNAC in the new law. So let's see if we can do some qualitative work that could guide us on that question, because I think there is a story there to tell. Absolutely, there is a story there to tell. But I don't have like a strong opinion on whether that's the case or not, to be honest.
Thank you, Raimundo. I don't know if there are other questions. Okay, well, thank you so much, Raimundo. Muchísimas gracias. And thank you everybody for being here with us in the seminar. Okay, well, bye.
Great, thank you very much, everyone. Bye-bye.
Bye. And I believe
Bye.
this is the last JiLAEE seminar of the semester, right? So we'll start again in fall 2022 or spring 2023.
Okay.
Or
Great,
sorry,
thank you.
spring 2022 in Argentina.
Great, thank you.